Welcome everyone. Welcome to another round of Leadership Connect on Kotak Cherry's YouTube channel. This time with us we have Mr. Sujit Modi, who is founder and CEO at Quantech Capital. So basically Quantech Capital is a quant-based investment advisory firm that uses principles of data science and quantitative finance for investing decisions. So and of course wealth creation. Sujit ji is CA and MBA from ISB and has 15 years of rich experience in area of capital markets. So Sujit, welcome to the show. Happy to host you.
Thank you, Janesh.
So friends, let us dive straight into the discussion, and we have very interesting topic that we are going to discuss today. So Sujit, I'll be as candid as possible and I'll ask you a direct question. Okay, and then there is a huge debate and huge wave going on around active versus passive. There is one school of thought which says we are an active management firm. There is other school of advisory that says that passive, most of the indices do not, most of the funds do not beat passive funds. So Sujit, where do you stand? Okay, and how should an investor, okay, who is as confused as me, go about this?
So before getting into this debate whether active is good or passive is good, let's understand why at all is there a need for this debate. So the moot problem is that the amount of money investor is paying today for getting a wealth solution in the form of different funds, different stock advisories and all, he is not getting adequate return that can justify his expense. So for instance, in a regular mutual fund active space, typically he pays around 2.5%, and in case of a direct fund, he pays around 1.5%. Official data says that majority of the active funds underperform the benchmarks. So the point is, if I am getting to invest in a benchmark at 20-25 basis point, but if I'm giving you 1% extra and I'm not even getting the benchmark return, then obviously I will question. So it's a valid question to ask from the investor's perspective. Now to answer your question, which camp do I fall in? I don't fall in any of the camp. I have my own camp, which is the third camp of factor investing. So essentially what we are doing is we are taking best of both worlds, where we are creating an active portfolio, but we are creating it in a passive way. It is a rule-based, completely process-driven portfolio. So that what happens is, if your market is falling in line with the process, you get the benefit of passive world because your cost of production is very low. You are not paying me 1.5-2%, because in traditional asset management business, constructing an active portfolio was a very time-consuming and was not very cost-effective business. But with all this computational power and technology being available, you can actually create the same active portfolio with a similar kind of better returns through a passive process, bringing down your cost of production.
So, but now another take on a topic which is happening right now in capital markets. So one day you see Nifty hitting 17,000, everybody is bearish. Okay, all the commentators, all the analysts come and say that the macro indicators are not really great. On one hand, then there is a story going on that India is the best place to be in.
Right.
So it gets really confusing, overwhelming at the same time. So in such a market, okay, there is a section which is a fan of momentum investing. But do you think momentum investing will really work in this choppy and sideways market?
So first of all, it's not a clear yes and a no answer, right? We just need to understand a little bit of a background. Market across all time frame always works in cycles. जो ऊपर गया है वो नीचे आएगा, जो नीचे गया है वो ऊपर जाएगा. Point is कि over a long period, where do you see the drift? On a longer period, do you see a drift going up, and in the shorter period you see the cycles moving out, or even in the longer period there are cycles and then there's a drift and so on and so forth. What momentum is trying to do over here is to make you walk that path of drift, that is the secular upward move. In between there will be ups and downs, you will make money, you will lose money, but on the long run, over the cycle is what we say. You should stay invested for the long run because you are able to complete the cycle. If over the cycle, if momentum is giving you good returns, then you should stay with momentum investing, and you should not allow the noise of 6 month or 1 yearly return affecting you in your wealth creation journey.
You have spent more than a decade in equity markets, 15 years. Okay, what are your learnings? What are your investment philosophies? And I assume that those will translate to Quantech Capital too. So what is the rationale when you say I have to bet certain amount on a particular investment? How do you go about it?
So there is one value system that we live by in Quantech Capital, that is stay invested, stick to the process, and follow the process very methodically. The point really is that market at the end of the day is a random mechanism, right? Somebody will say the prices moves randomly. Somebody will say that it is a discounting mechanism. It tries to see how much wealth it can create for you. But that at the end of the day, as I mentioned, that there is a drift element and there is a cyclical element. Don't let the cyclicality push you away from your drift element. So stay invested, stick to the process, and if you are following any advisor, do what advisor is asking you to do, provided you believe him and there's no conflict over there. But it is very important that you stay disciplined in your wealth creation journey and don't let cyclicality or noise push you away from your path of discipline.
Thank you, Sujit, for your thoughts and giving us your valuable time. So, friends, that was Sujit Modi, founder CEO at Quantech Capital. See you in the next round of Connect on Kotak Cherry. Till then, take care and stay happy investing.
Thank you.